We're in one of those interregnum periods where we've just seen a major downward revision in a series that has its tentacles in a lot of other upstream tentacles. So when there's a major downward revision of non-farm payrolls, that goes a lot of places. For example, non-farm payrolls are used to compute personal income, which means personal income is overstated, which means that gross domestic income is overstated. Since hours worked, which is employment times the work week, is used to compute productivity, the productivity figures are understated. Because the productivity figures are understated, the unit labor cost figures are overstated. Because the gross domestic income is overstated, the saving rate, which is already at a paltry 3.5%, is going to be lowered. And because GDI will be lowered, we have a greater gap between gross domestic product and gross domestic income. And that shouldn't be. Those are equivalent concepts. There's a bureaucratic failure when there's a major deviation, which we've been experiencing, which will now be exacerbated. We can tolerate small misses, and we expect that. I mean, we don't have full samples all the time, but this downward revision in the payroll was very significant. The Labor Department says that one standard error is plus or minus 0.1%. We had a 5 sigma error in the numbers just released, which was the worst since the 9 sigma era when the 2009 data was released in 2010. Let's take one other indicator where the non-farm has a reach. The non-farm payroll is one of the 4 coincident indicators. It's measured by the Conference Board. Well, in July, the coincident index of economic indicators was flat based upon the numbers that have been reported. And we now know that they have to be revised. And another problem here, and this is really an indication of the fact that the bureaucratic process is going off base. The official numbers, those that are in all the databases, will not be revised until February of next year. In other words, so we've been alerted that there's an error factor, but we have not been given the monthly seasonally adjusted numbers to reflect this. We were given non-seasonally adjusted quarterly numbers, and this already has showed up. For example, when the BLS made this announcement, they said that the error factor was 818,000. That was the 5 standard error miss. But apparently, based on my calculation, that's based on an internal BLS seasonally adjusted series. All that the private sector can do, all I can do, is compare the not seasonally adjusted quarterly census of employment and wages numbers with the non-seasonally adjusted payroll data. And if you do that, you find that the cumulative error was not 818, but it was 915,000. There may be other explanations that I'm not aware of, but here again, we're dealing with the fact that there is this huge body of information from 11.2 million firms that are included in the QCEW that have not been fully released to the public, other than to alert the public that there was a huge overshoot. Now, there's another consequence of a big mess like this. Monetary policy was based on the numbers that BLS has been putting out. And so they were making policy on erroneous decisions. And perhaps somewhere in the juggernaut of fiscal policy, someone was misled as well. We don't know. But the possibility of that exists. But even more importantly, there were corporate decisions in terms of firms making planning for what they expect in the way of demand and inventories and production. And then, of course, there are the decisions that are being made by portfolio managers, traders, and investment managers as well, who are taking this data at face value and reacting to it, because that's what the market is reacting to. And now we find that the data considerably overshot. So substantial miscalculations were made. What really concerns me about this is that after the huge miss in 2009, the Bureau of Labor Statistics said that they had corrected the problem, that the error in 2009 reflected the fact of a very serious recession and the great financial crisis. Well, the other data indicates the economy is still chugging along. It's slowed down. But we may have that perception in part because of the bad data that the Labor Department has been feeding us. We know, for example, that we have some important sectors that are not doing well. For example, if you look at existing and new home sales versus their best levels of the last 5 years, they're down in the 35 to 37% range. If you look at vehicle sales in the latest several months, they're 14 or 15% below the best levels of the last 5 years. If you look at the standard of living, which is the inflation-adjusted weekly paychecks of our full-time, hourly, and service employees, that's 120 million people. And this expansion, which has been running now 16 quarters, if the data is right, and some of this data is flawed, but based on the numbers that are the paychecks that are taking home the standard of living, 120 million people, in the last 16 quarters, 4 years, is declining at close to a 2% annual rate. That's without making any adjustments, which I can't make because I can see the magnitude of the error that they made, but I can't correct the other data, and I don't believe anybody else can. So we're dealing with a situation that is really unpalatable, and there are a lot of calls going on for greater government. Well, and in theory, maybe government works, but we all know the experiences of the post office, and we also know the difficulty of trying to get permits for a variety of different things. And we know the difficulty of dealing with the IRS. We now, our experiences at the post office, the IRS, and obtaining government regulations, that those problems are now apparent in the vitally important Bureau of Labor Statistics, a reminder that they have not fixed the problem. There appears to be a broad breakdown in government, particularly in the Labor Department and other well-known cases. This is not a good time to know exactly where we are. But I believe the economy is deteriorating, has substantial problems that we're facing for two fundamental reasons. And fortunately, in this area, there are errors in the data because of the payroll, but at least in the monetary area, we have pretty clean data. And as you may know from having read our latest letter, I believe that you should take both M2 and what I prefer as a measure of money, other deposit liabilities, and you should adjust for inflation, and you should also adjust for the trend rate of growth in money. You have to look at money against what it typically grows at. Since the 1950s, M2 in real terms has grown 2.9%, and velocity has declined at 0.2% per annum, which means that a steady state rate of economic growth would give you 3.1% real increase in M2. And that would be neither inflationary nor deflationary. But currently, in trend-adjusted terms, M2 is declining at almost a 3% annual rate. And we've just witnessed the largest deceleration in real M2 from its peak levels in 2020 and 2021 to where we are now for all but two periods. One was in the 1930s, and the other was immediately after World War II. Very unusual circumstances. The Fed has engineered a very restrictive monetary policy. A second problem that we have, and this probably surprises a lot of folks, fiscal policy is not working for us. It's working against us. John Maynard Keynes based his call for budget deficit on something called the fallacy of thrift. And he said that major recessions occurred because individuals, in doing the right thing for themselves, planning for the future, building in contingencies, and so forth, they oversave and there's not enough spending. And therefore, to deal with the paradox of thrift, Keynes said the government should run budget deficits. Well, that argument disappears in the current situation because if you look at net national saving, which is a very critical indicator, which very people look at, we've got a problem. Net national saving is the saving of the private sector. And the private sector has two components, the household and the corporate sector. And then it has net foreign saving. And then it has government saving, which in the current situation is negative saving. We call the budget deficit negative saving in the terminology of economics. And so we've now incurred negative net national saving for 5 consecutive quarters. The latest quarter is $140 billion. Which means that the government dis-saving of roughly $2 trillion, dealing in really big numbers here to make the case easier to understand, is greater than the private and foreign saving, which is only about $1.85 trillion. That's why we have a deficit in negative net national saving. In economics, there are certain fundamental relationships hold. And one of them is the circular flow. What we spend equals what we earn. Gross domestic income equals gross domestic product. You can manipulate the circular flow. You can rearrange the algebraic relationships. And out of that comes something that's equivalent to saying GDI equals GDP. And that says that physical investment I equals net national saving. Well, if you have negative net national saving over time, you're going to get negative net national investment. Well, net national investment constitutes the increase in the capital stock. Without an increase in the capital stock, you cannot raise the standard of living. And that's already happening to us. Some numbers here that really worry me a lot. When we started on this path toward increasing over-indebtedness and more larger and larger levels of government debt, the standard of living for the 100 years before 1970 were growing at 2.3% per annum in real per capita terms. And by the way, I take the average of real GDI and real GDP. If you look at the last 20 years, we're growing at 1.3% per annum. So we've lost more than 40% of our growth rate against trend since 1970. In 1970, government was about 26% of GDP, and it's now 10 points higher. There are two very noted Swedish economists that wrote a great paper in 2000 by the name of Henriksen and Berg and Henriksen. Both of those economists taught at Harvard. They're excellent econometricians. They pointed out that as the government size grows, for every 1% increase in government size, you lose about 0.1% of your growth in the standard of living. And so the numbers that I just gave you are confirmation of the work and the projections that the work of Henriksen and Berg did in 2002 are correct. They postulated that we would lose 0.1% for every 1% increase in the size of government. Government size has increased 10%. We've lost 1% against trend. And by the way, you see that occurs very slowly. It's imperceptible. People don't feel it in any one year. You have to look back at the last 20 years and you see that we're losing in the growth rate. And this has implications. One of the reasons why the household formation rate is down, why the birth rate is at a record low for young households can't afford children. This is basic to economics. Physical saving must equal physical investment. Some people say, well, if we have negative net national saving, we can have the Federal Reserve accelerate the money supply growth, which is what was done in 2020 and 2021. But increasing the money supply doesn't increase physical assets to consume. You have to have someone push back from the dinner table. There has to be saving out of income to finance physical investment. So when we relied upon the Federal Reserve in 2020 and 2021 to overcome the deficit in net national saving, what did it do? It produced horrific inflation. And then the horrific inflation had a devastating impact on our modest and moderate income households. It appears that the standard of living has declined very significantly in the last 4 years. Our modest and moderate income households cannot survive an inflation. So you take what seems to be an easy solution, have the Federal Reserve rev up the money supply. The Fed revs up the money supply, but more assets are still not available. And so people take advantage of the low interest rate and the resources that are available to acquire the resources that they need to spend, but they're not there. And so immediately the inflation rate shoots higher. And so we went from an inflation rate in the 2000s and the 2016s of something less than 2%. The final 5 years of 20 teens, we had an inflation rate that was only around 1.5%. But when you gave it that toxic mix, and now people say, well, it was necessary. We were in a pandemic and people were hurting and we had to help them through and so forth and so on. But we helped them through only for a couple of quarters. And then pang, they got hit with higher inflation. In fact, they still are being hit with higher inflation. Because when you have a massive increase in inflation, such as we had in 2020 and 2021, it resulted in a dramatic increase in your big tickets, particularly cars and housing. So now the Federal Reserve policy is bringing down the rate of inflation of small items, but the level of car and home prices are still extremely elevated. Those price levels are unprecedented. Yes, the automobile companies have lowered prices every month this year, but they've lowered them only about 1% after going up 20% during the pandemic. Cox Automotive did a study late last year which showed that 2/3 of our households cannot afford a new car, whereas historically only about 45% of our households have been unable to afford a new car. Well, that's a hangover of the higher inflation. And one of the reasons that people think the inflation is really the change in prices. But to the average ordinary person, they're looking at the price level as well as the change. And a lot of them are not seeing the improvement in inflation because the critical things that they want to buy that are essential for a good standard of living, like new cars and houses, are so expensive. And we're left with that. And we're going to be left with that for a long time. And there are a variety of indicators of housing affordability. And what they all show is that housing affordability is, if it's not at a record low, it's near a record low. And that's a residual of the policy mistake of trying to cover negative net national saving by having the Federal Reserve printing money.